You should avoid funds where there are frequent changes in top positions, like the CEO, CIO, and fund managers. You must evaluate the experience and past performance of the fund manager. And here's a pro tip. Dig a little deeper and evaluate the performance of other funds they have managed in the past. Think about it. Top performing funds change almost every year. So instead, focus on how the fund has performed over a longer period, say 8 to 10 years. It's easy for a fund to look great when the market is booming. The real test is how it holds up when things get tough. Many people keep adding a new fund every 1 or 2 years. They just check which fund has given the highest returns in the previous year and then they invest in the fund. Also ensure you do not have too many funds in the same category. Check if your funds complement each other. Some investors believe that a low NAV means a bargain and it will give better returns, but that's not true. Another mistake people make in mutual fund investing is to opt for the dividend plan. Be careful of extremely large funds. Instead of worrying about whether the market is too high or if you should exit, ask yourself, do I need the money now? Hello people, I am Suraj Deo and welcome back to Deo Talks. In today's video, we will discuss the 8 common mistakes that most people make while investing in a mutual fund. Each of these mistakes is equally important, so stick around until the end of this video to learn how to avoid them all. Okay, mistake number 1, ignoring AMC history and fund managers' track record. The asset management company or simply the mutual fund companies and their fund managers' reputation and track record should be the key factors in selecting a mutual fund. But the truth is, most people ignore these criteria. A well-established fund with a long history of successful fund management indicates stability and expertise. So you should look for a mutual fund with a strong financial position and consistent performance across different market cycles. Also check if there is a stability in the fund management team. You should avoid funds where there are frequent changes in top positions, like the CEO, CIO, and fund managers. The best funds have a stable, long-standing team that ensures continuity and a consistent investment policy. Now let's talk about the captain of the ship, that is fund manager. You must evaluate the experience and past performance of the fund manager. They should have a proven track record of picking the right stocks and building strong portfolios. If the fund manager continuously performs well for a long time, that's a green flag, and it may indicate that such a mutual fund scheme may repeat its performance under similar market conditions. And here's a pro tip. Dig a little deeper and evaluate the performance of other funds they have managed in the past or are currently managing. Believe me, these are not just theoretical stuff. Most of this information is easily available on the internet today. Mistake number 2, choosing mutual funds based only on their past performance. See, consistency matters more in the long run. So don't chase top performers basis the past few years. Think about it. Top performing funds change almost every year. So instead, focus on how the fund has performed over a longer period, say 8 to 10 years. Look at its performance during both good times, that is bull markets, and bad times, that is bear markets. It's easy for a fund to look great when the market is booming. The real test is how it holds up when things get tough. Remember, past performance is not a guarantee of future results. A fund that was a star yesterday might not shine tomorrow. So do your research and don't let short-term gains blind you to the bigger picture. Mistake number 3, holding too many mutual funds. Many people keep adding a new fund every 1 or 2 years. Generally, they just check which fund has given the highest returns in the previous year and then they invest in the fund. But think about it, mutual funds are already diversified. Having too many funds makes them difficult to manage and monitor. Also, holding too many mutual funds can lead to overlapping investments, meaning you might end up investing in the same stocks through different funds. This reduces the benefit of diversification. Also, having more funds means you will be paying more in management fees and expense ratios, which eat into your returns over time. So the question is, what should you do? Just keep a maximum of 4 to 6 mutual funds with the right mix of equity funds, debt funds, liquid funds, etc. Here's why. When you invest in any mutual fund, it's crucial to track the performance. You need to benchmark with the indices, and you also need to check that the expense ratio is under control. All of these take time. So tracking the performance of few funds can be doable, but not in case you invest in 8 to 10 funds. Also ensure you do not have too many funds in the same category. Like if you have 2 or 3 large cap category funds in your portfolio, then actually you are holding same or similar stocks through these funds. So it will limit your diversification. You should also check if your funds complement each other. For example, you can combine large cap funds with small cap funds to better manage your risk and increase your return potential. Mistake number 4, thinking that lower NAV gives better returns. During a new fund offer or an NFO, a mutual fund house raises money from investors for that new fund. Think of an NFO as an IPO for mutual funds, offering units instead of shares. NFOs launch with a low net asset value or NAV, often around ₹10. Some investors believe that a low NAV means a bargain and it will give better returns, but that's not true. First, one should avoid investing in NFOs as these funds don't have a history or proven track record. It's always better to go with a fund that has proved its worth across market phases. Second, please do not think that a low NAV means a cheap fund. The NAV alone doesn't directly indicate whether a fund is overpriced or underpriced. NAV simply reflects the current value of the fund's underlying assets. The NAV at which you buy the mutual fund units is not important. What matters is the price the fund manager pays for buying different stocks under the fund. And remember, it's not about the NAV figure, but rather the change in NAV during a period that affects your returns over time. One small request before we move further. If you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. Mistake number 5. Opting for the dividend plans instead of growth plans. Another mistake people make in mutual fund investing is to opt for the dividend plan. When you choose the dividend option, the fund pays out a portion of its profits in the form of a dividend, reducing the net asset value or NAV per unit of the fund. Actually, you receive regular payouts but at the cost of NAV reduction of your own investment. It's important to note that the market regulator SEBI has changed the names of these plans to IDCW as their payouts are not really dividends. What you get here is a part of your capital and a part of your returns back. Hence the name IDCW, that is income distribution and capital withdrawal. So if you are investing in mutual fund for the long term, do not go for the dividend plan. Dividends are good if you want regular income, but if your goal is wealth creation, you should always opt for the growth plans, wherein the profits earned by the fund are reinvested, which leads to the growth in the NAV of your funds and therefore generates better returns. Mistake number 6. Opting for regular plans instead of direct plans. Direct plans allow investors to invest in mutual funds directly with the fund house without going through an intermediary such as a broker or distributor. This means that investors can save on the commission that would have been paid to the intermediary. As a result, direct plans have a lower expense ratio, so better returns than regular plans. On the other hand, regular plans are the traditional way to invest in mutual funds and they are sold through intermediaries such as brokers or distributors. These intermediaries charge a commission for their services, which is reflected in the higher expense ratio of regular plans. So you should always opt for direct plans. Mistake number 7. Ignoring the fund size while selecting a mutual fund. A moderate size funds with a substantial AUM often indicates stability and liquidity. But be careful of extremely large funds as they might struggle to invest all their money efficiently. Their large size can limit their ability to react quickly to market changes, which can lead to lower returns. So watch out for potential issues if the fund you invested in becomes too large. Smaller funds might offer higher returns but can be more volatile. The ideal fund size depends on your risk tolerance and investment goals. If you are risk averse and prioritize stability and liquidity, then opt for moderate size or large funds. If you are seeking alpha or superior returns and comfortable with high risk, then consider smaller funds with experienced fund managers. However, if you have a specific short-term goals and want better liquidity, then choose large or moderate size funds for easy entry and exit. Therefore, it's very important to assess the fund size carefully when investing in mutual funds. Mistake number 8. Redeeming your mutual funds too early or stopping SIPs due to market noise. Many investors make the mistake of selling their mutual funds as soon as they hear about another top performer. But remember, there's no such thing as a consistent top performer. The stock market goes up and down, and that's normal. Don't panic and withdraw your funds when the market dips. If you are investing for the long term, stay invested and ride out the ups and downs. Instead of worrying about whether the market is too high or if you should exit, ask yourself, do I need the money now? Market noise can make you panic and follow the crowd without thinking it through. But remember, the market has always rewarded investors who stay patient. Keeping your investments for the long haul helps your money grow through compounding, and that is one of the safest ways to make money from the stock market. So next time you invest in a mutual fund, make sure to avoid all these mistakes. By doing so, I hope and pray you will achieve much better returns on your investment. That's all for now. Please feel free to leave any question or comments below. Thanks a lot for your time and let's take care of this beautiful world. I'll see you next. And smile. Always smile.